And anyway, silver is now, by our metrics, the spread chart versus gold, especially saying, okay, I'm out of here. We think silver is highly likely to go, I think, personally, my own positions, which I expose in the report at the end in a disclaimer, is likely to see, $200, and it might even see it within the next handful of months. In other words, within a couple quarters of that breakout.
Michael Oliver believes silver has decisively broken out of a multi-decade trading range and entered what he calls a new reality. According to his momentum and relative performance analysis, silver could surge rapidly, potentially reaching $200 or more within just a few quarters. Oliver's case rests on powerful breakouts, silver outperforming gold, and precious metals collectively breaking away from the S&P 500. These signals, he argues, point to a major capital shift out of equities and into monetary metals. He also sees gold in a strong long-term advance. If gold repeats historical logarithmic moves seen in previous cycles, Oliver suggests prices could ultimately approach $8,000 over time.
I think we've begun a phase in silver that we've explained to our subscribers over the last handful of months is likely to be a jolting one that takes silver to what we call a new reality, meaning not just doubling the price, but, more likely quadrupling or more the price very quickly, meaning within 2 quarters, thereabouts. The signal that generated that was not the fact that the net trend of silver and gold is positive. They've been positive for a couple of years. They zigzag, but, it's been net trend positive. So it's not that issue. It's the issue of the relative performance relative to, one, the stock market, meaning a breakout that is clear, technically speaking, in which the performance of gold, for example, versus the S&P is no longer a duel, which for the last 10 to 11 years, if you looked at a spread chart of gold divided into the price of the S&P, you'd see this basing pattern with ups and downs within it, in which case gold outperformed for a year or two and then pulled back some, and, so basically sideways, where it was basing relative to its performance to S&P. It broke out of that pattern in November. And now it's 1 month later and we've gained hundreds of dollars and the spread has continued to explode. But also when we analyze gold miners, gold and silver miners, like let's say GDX or XAU, and divide it into the S&P 500 and plot the same chart going back a dozen years, lo and behold, it broke out also in November, meaning, which place should I be, the U.S. stock market or gold and silver miners? Well, it said gold and silver miners. Well, they've roared since November. They've been roaring before that, but this thing said something just began. This is a big metric. I mean, you don't build a base that's 11 years wide, clearly defined with multiple highs that hit the same sort of level, and you can draw a line, anybody could, and you break through that. That's a breakout. It's fresh. And silver did the same. But the other thing that we thought was more important for silver is that it broke out versus gold. Meaning that if you want to allocate assets to monetary metals, fine, that's what these charts tell you to do. But within that complex, you want to preference silver. It's likely to lead. Silver's also broken out of its what we call the idiot range, which it's been in for 50 years. $50 for $4, $50 back down, 50 years in a range, an old normality. We showed in reports a couple months ago a similar situation in copper and lead that had prevailed back in the 70s through 2005 to 2007. It's like multiple decades of range-bound action by both those base metals. And in 2005, copper broke out of that range, and in 2 quarters, it quadrupled in price, and then lived in a new reality subsequently. Now it's breaking out again to another reality. Lead did the same thing. In other words, when it finally decided in 2007, on its own merits, to break out of a multi-decade old reality, it quadrupled in a matter of a couple quarters. What's going on here? Well, it's when the market discovers, oops, I made a mistake. I shouldn't have been here that long. Boom. Markets make mistakes. They're not rational all the time.
Addressing concerns that a stock market decline would hurt silver, Oliver dismisses the fear. He notes that correlations between equities and silver are inconsistent, and history shows that monetary metals often rise independently, especially during the early stages of equity sell-offs. Overall, Oliver views today's setup as the opening phase of a broader fiat currency and debt crisis, one that strongly favors gold, but especially silver, which he believes has the most explosive upside potential.
Well, we examine platinum, palladium, and all the other components of the Bloomberg Commodity Index monthly, technically examine them. And platinum, I know a lot of people like to link it to gold. But unfortunately, or fortunately, whatever, the reality is that if you go back decades and decades and look at platinum and look at gold, they do not correlate well. There have been times when they do, but there's also been times when the Bloomberg Commodity Index correlates to gold. So, you can't say corn is like gold, okay? You get the point. So platinum broke out by our metrics a handful of months ago and has since roared. But it did it pretty much in sync with the Bloomberg Commodity Index and, let's say, the action of copper, for example. So we think quietly it is a precious metal. It is not a monetary metal. And that it's not just a subtle difference. That's important, I think, because ultimately what we're facing here for gold and silver, that's something the analysts just don't seem to get their head around, is that we're facing a fiat money crisis. And we've had like 100 years of that unbacked stuff, and it's finally reaching a crisis point because the focal point now is the U.S. government, and Japanese, and UK, and et cetera, debt markets, their debt. And when you reach that crisis, you've reached the big one. And that's when the issue of fiat currencies comes into question. And already there are movements we know around the world, here, there, in this country, that country, to move more toward a gold-backed situation. And this coming crisis, which, again, I don't see analysts talking about, is going to hit. And when it hits, then suddenly they'll say, gee, that's the reason, huh? Oh, now I understand. Anyway, that's where I think we are, and I think 2026 is going to expose, if you go back and examine the two acceleration phases of silver that occurred within the old reality, that would have been 1979 to 80, when after years of advancing already at that point, silver exploded. It like quadrupled in a matter of 5 months, it was. Went from like $12 to 50, okay? And then in 2010 and 11, again, after years of advance, so it wasn't like some new game, silver doubled in a half in about 7 months. Boom. Okay. But in the middle of both those moves, if you micro-analyze them, which we've done, there was, in fact, a midpoint, what you might call stumble, or a midpoint pause, or a midpoint correction. It really didn't amount to much other than, for a moment in time, making people feel like, oh my gosh, that's the top. But that was only like 3 months into what we define as the couple quarter move. And so sure enough, after that little jig-jag was over, right about in the middle of that clock, they exploded again, even more so than what they'd done in the first half of that clock. So the question now is, let's say we got a signal in the close of November. So let's say this is month 1, 2, 3. So maybe you get to February or so. At that point, we're going to be focused at MSA on trying to define any midpoint stumble. It will be a fake out, but we still know that there's a lot of, including myself, a lot of investors who are positioned in call options and therefore are sensitive to such fluctuations. So it would be an important thing to avoid if you can, but you don't, as an investor, want to get out of silver at that point. In fact, you don't want to get out of silver, period, even after the 6-month move, because there's a new reality about the dawn. And while price will have made much of its move, but the interesting point, though, will be, let's assume the 6-month clock is about right, give or take a month, okay? And again, this happened to copper, it happened to lead, it happened to silver twice in the past 50 years. Where are you going to be at the midpoint of that move? Could be very interesting. Are you going to be 80, 95, let's say 95 to $100? And I picked that because that's a stupid level. Why is that stupid? Because if you take the arithmetic range of the past 50 years and you simply add it to itself, the target would be roughly somewhere close to 100. $50 range added. So it's sort of an idiot technical analysis. What we're arguing is you should do it on a logarithmic scale. And if you take that range that was like $4 to 50 for 50 years and you double it, you double the range on the log scale, which is like a tenfold range, $4 to 50. You're talking $500. Don't chuckle. The interesting thing, well, where will we be, let's say, about 3 months into this move? Will we be under 100? Or will we be well over 100? And then we get a jiggle. Because that sort of sets your dynamics. You think, well, if we got this far in the first 3, good grief, where are we going to be in the next 3? Maybe 200's too low. So we're not certain on where that peak might be in 6 months or so. Although I would argue at least 200. But a lot's going to be told in the next couple of months. Where do we go, let's say, within 3? That correlation, by the way, is a coin toss. We've studied it, put out reports at length going back to the 50 years or so, examining the movements of gold, the miners, etc., during stock market downturns. And the response by the gold miners, silver, it's a little bit different each time, but not always do they respond to sharp stock market downturns. And plus, I say sharp because the stock market could go down and it won't affect silver and gold at all. I mean, you look at 2007, let's take as an example. It peaked in October 2007. Dropped November, December, January, February, March. 6 more months passed while the stock market was declining, not collapsing, declining hard though. And gold was continuing up and miners were continuing up during that same 6-month period. It was only when you got to September, October of 2008, a full year after the bull market peak in stocks, way off the price high, that finally gold and the miners and silver have a very sharp drop that seemed to be correlated to the S&P, although they certainly weren't correlated in that first year of the bear market of stocks. So it's an iffy correlation. In fact, we showed charts in a recent report where back in the 2007-8 period when stocks topped, you looked at wheat, corn, and soybeans and gold. They correlated much better, so you could argue, oh no, gold went down because the grains topped. Because they topped also not with the stock market, but later on, like in March or so of 2008, 6 months off the stock market high. So you could almost make a better correlation and say, well, got to watch corn, beans, and wheat because that affects gold. Or is it the other way around? Maybe gold affected them. You get the point. Yes, there can be correlations as far as the stock market goes. I don't think there's going to be a sharp collapse type of event in the stock market until certain other things happen. We've been arguing for the last month that the stock market decline is not going to commence right now because we've already wasted too many months on monthly momentum of the S&P or NASDAQ and trying to go down on those metrics. You get downward readings on momentum, yet price was just struggling sort of sideways for especially the last 3 months. So when we see that waste of time on momentum, where there is a decline on the momentum readings, but no real response by price, then as far as we're concerned, for the moment, the bear clock is over. They've had their chance. We're likely now to see, and we said this in a report 2 weekends ago, you're likely to see further gains in the S&P before you even start to top again. But overall, from an investment context, we've been arguing that since early this year, when the S&P was like just below 6,200 at the peak then, that what you're going to see is a topping process. Could involve a year. That's what happened in 2000. That's what happened in 2007. It took a whole year of this twisty-turny but slightly rising action to top it out. But the structures that we see on momentum that could cause a precipitous drop are next year likely to be in the mid 5,000 area. So in other words, 1,000 points below, like at 20% below where the market is right now, before you hit levels that will cause a sharp drop. So in other words, we could see the stock market roll over, gold continue on up, silver, etc., and not see the stock market really get kicked in the shin until you get down into that 5,400 zone. There's technical reasons for that. When you hit that level, you could see a sharp drop. But who knows? Maybe at that point, here in April or May, and suddenly your 6 months on silver are over, and silver's reached some kind of level like 200 or 500 or whatever, and has a sharp correction coincident with a stock market break, but at a new reality level. The issue is getting to the new reality for silver. And right now, I don't think the stock market is going to be a problem in terms of generating anything.